Welcome. In this video, a 1,450% rise for Zbcn coin holders is at the door. So why? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Looking at the most recent candlestick formation, we can see that the pattern formed is a bullish engulfing pattern. This formation is considered quite strong in technical analysis, and especially when it appears at the end of a downtrend or during a correction phase, it is interpreted as a sign of a new upward movement. The bullish engulfing pattern, as its name suggests, consists of a large green candlestick that completely engulfs the previous red bearish candlestick. This indicates that the market is psychologically shifting from a bearish outlook to a bullish one. Buyers are overpowering sellers, creating a new momentum in the market. The existence of this momentum significantly increases the likelihood of prices moving upward in the following candles. One of the most important points to note here is that the body of the bullish and golden candle must completely cover the body of the previous red candle. If this condition is fully met, it is considered a strong bullish signal from a technical perspective. This structure shows that sellers can no longer impose significant pressure and that buyers have taken control of the market. In other words, a new balance of power has emerged in the market, favoring the buyers. This makes it highly likely that the price will rise in the upcoming candles. Looking at the psychological structure behind the bullish engulfing pattern, we can see that sellers attempted to push the market downward in the previous candle but failed. Especially if a small-bodied red candle is followed by a large and strong green candle, this proves that buyers have returned to the market with strength. That is why technical analysts consider this formation an important signal for the start of an uptrend or the continuation of an existing bullish move. The reason the price is expected to move upward in the coming sessions is precisely this. A strong green candle not only closes out the past, but also reshapes future expectations. When traders see this type of formation, they generally become more eager to enter the market on the buying side. This eagerness increases trading volume, and the rise in volume pushes prices higher and faster. Another factor to pay attention to is the region where the formation occurs. If the bullish engulfing appears at a support level or at an important Fibonacci level, its strength increases significantly. This is because we already know that buyers tend to be active in support areas, and a strong formation appearing there accelerates upward price movement. This shows that the market is not only technically, but also psychologically embraced by buyers. In such cases, the likelihood of price moving upward in the following candles becomes much higher, particularly if the overall trend structure shows that the market was already in an uptrend but made a minor correction. Then a bullish engulfing pattern is one of the strongest signs that the correction has ended and that the price is ready to resume its upward movement. At this point, although the probability of price increasing in the next candles is quite high, it's important to remember that traders should not make decisions based solely on a single candlestick pattern. However, the appearance of a strong pattern like the bullish engulfing is already a positive sign for the market. And when it is supported by additional indicators and volume analysis, the reliability of the signal increases further. In addition, since the bullish engulfing pattern often has the power to change market direction, investors tend to feel more confident psychologically when they see this pattern. Traders who have been anxious and fearful of losses during a downtrend feel more relaxed when such a strong structure appears and become more willing to buy again. This natural increase in buyers pushes prices upward. Therefore, the probability of prices rising in the following candles is not just a technical possibility, but also a psychological inevitability. As confidence grows, buying activity increases, and as buying increases, prices rise. Thanks to these advantages provided by the bullish engulfing pattern, investors are expected to approach the market with a more positive outlook. This pattern is both a technical sign of bullishness and a psychological indicator that market participants are motivated to buy. As a result, the likelihood of prices rising in the following candles becomes a very strong scenario. Typically, after such formations, the market gains upward momentum for several candles. Although this momentum can occasionally be interrupted by corrections, the overall direction remains upward. In other words, the probability of continued bullish price action in the near future is high, supported by both the candlestick structure and the general market psychology. In conclusion, the most recent bullish engulfing pattern shows that strong buying pressure has returned to the market. This significantly increases the probability of prices rising in the next candles. The formation has broken sellers' dominance and proved that buyers have taken control of the market. With this control established, the potential for a new upward trend to begin is quite high. Correctly interpreting this signal is important for traders to take advantage of market opportunities. However, if supported by additional indicators and volume analysis, this probability becomes even stronger. But even on its own, the bullish engulfing pattern is considered a powerful and positive sign for potential price increases in the following candles. But we can't rely only on candlestick analysis, so let's take a look at other metrics as well. Stay tuned. The presence of resistance above the price is a highly important structure in technical analysis because resistance zones are the obstacles a price faces in its upward movement, and they usually correspond to levels where the price has struggled to rise in the past. These levels are also tied to investors' psychological boundaries. For example, if the price once rose to a certain point and then sharply dropped due to heavy selling, that zone remains in investors' minds as a top or a selling area. Therefore, when the price approaches the same level again, many investors act with the same psychology, turning to selling, which can once more cause the price to retreat. This is why resistances are extremely critical turning points in the market's forward trajectory. For the price to continue its uptrend, it must break this resistance. If it fails to do so, upward momentum can fade and downward pressure may reappear. On the other hand, if resistance is broken to the upside, it opens the door for the price and can lead to much stronger rallies. To understand a resistance zone, one must look at past price movements. These zones usually arise from long periods of sideways action or from previous peak points. For example, if the price of an asset rose to $100 and then fell back to $80 due to heavy selling, the $100 level becomes a strong resistance. This is because a significant portion of investors sold at that level, and when the price reaches it again, the same selling pressure can be triggered. However, if the price breaks through that $100 resistance with strong volume, increasing momentum and consecutive waves of buying, this may signal the start of a lasting uptrend. This is why technical analysts pay attention not only to whether the price surpasses resistance, but also to the trading volume and candlestick closings at that moment. For instance, a daily or weekly close above resistance provides a much stronger confirmation of a breakout's validity. Another key point is how often a resistance level is tested. If the price has reached the same resistance many times and pulled back, with each attempt, the chance of that resistance weakening increases. This can be compared to a rubber band being stretched repeatedly. The more it is stretched, the more likely it is to snap. Similarly, when the price repeatedly tests resistance, a day comes when the resistance finally gives way and breaks to the upside. At that moment, the market often sees a sharp rally because the price's biggest obstacle has been removed. The breaking of resistance is also very important in terms of trend continuation. If the price is in an uptrend and keeps surpassing resistance levels one by one, this indicates that the trend is healthy and strong. For investors, this is a reassuring signal because the ability of the price to make higher highs consistently confirms the strength of the trend. However, if the price keeps stalling at resistance and cannot manage to break upward, the trend is considered weak, and this leads to uncertainty in the market. Sometimes a catalyst is needed for the price to break resistance. This could be news, economic developments, an earnings report, or in the crypto market, a new update. When fundamental factors align with technical analysis, the likelihood of breaking resistance increases even more. This is because not only the technicals, but also the market psychology gain new strength. At such moments, investors are more eager to buy, and the price finds room to rise. In the crypto market especially, resistance breakouts often result in sharp moves because volatility is inherently high. Even a small breakout can trigger a large rally. This makes investors quicker to act on opportunities. Still, after breaking resistance, it is common for the price to consolidate sideways for a while to gather strength. This process confirms that the broken resistance has now become solid support, which is a healthy sign. In conclusion, resistance above the price is one of the most critical turning points in the market. It determines the direction of the price, affects investor psychology, and shapes market dynamics. If the price fails to break resistance, bullish momentum may remain short-lived. But if the breakout succeeds, it not only drives the price higher, but also increases confidence in the market. Investors become bolder, new buyers step in, and the uptrend continues with greater strength. This is why breaking resistance levels is one of the most decisive events in technical analysis, and investors must follow these zones closely.
The inverse head and shoulders pattern is one of the most trusted reversal formations in technical analysis and is closely followed by investors with hope. This formation usually appears after a long-lasting downtrend and is a strong indication that sellers are losing their grip on the market while buyers are gradually starting to take control. In the situation you mentioned, the price is currently forming the final shoulder, which points to a very positive picture in the bigger picture. This is because the right shoulder of the formation shows that sellers can no longer push the price down to previous lows, meaning their pressure is weakening and buyers are starting to react from higher levels. This is also psychologically powerful. Most of the previous selling pressure has been exhausted, while new investors are becoming more eager with bullish expectations. Thus, the likelihood of the formation completing becomes quite high. The depth of the head is a critical factor in target measurement in technical analysis. In an inverse head and shoulders setup, once the neckline is broken, the price is expected to rise at least as much as the depth of the head. In this case, the calculated target pointing to an extraordinary 1,450% increase actually reveals that there is very strong bullish potential in the market. Of course, such a large target will not be reached in just a few days. It will play out in waves. However, from a long-term perspective, such large targets provide investors with great hope and motivation. This is because the role of formations in market psychology is not only about prices reaching technical levels, but also about boosting investor confidence, which helps accelerate the move. In other words, calculating this target is not merely a mathematical exercise, it also guides the expectations of market participants. The fact that the price is now forming the last shoulder shows that we are in one of the most critical stages of this formation. The process of building the right shoulder is usually the period of final uncertainty in the market. Some investors still believe the downtrend may continue, while others sense that a new rally is approaching. Small pullbacks and upward reactions during this stage reflect a kind of power struggle. From a technical perspective, however, once the right shoulder is complete, the likelihood of the price moving toward the neckline becomes very high. When the neckline breaks, it is usually accompanied by a strong surge in volume because this breakout confirms that buyers have decisively taken control. At this point, many technical analysts and large investors take positions, fueling even stronger upward momentum. A massive target like 1,450% is a move that could change the fate of a market. A formation pointing to such a target reinforces investor confidence in the future and sets the stage for long-term price movement in that direction. Of course, no technical analysis is absolute, but the fact that a reliable formation such as the inverse head and shoulders shows such a large potential indicates that optimistic expectations are based on solid ground. The most important factor to watch here is the confirmation of the neckline breakout. For the formation to gain true validity, the price must move sustainably above the neckline. Once this happens, the probability of moving toward the projected target increases significantly. The psychological effects in the market are also crucial here. In an asset that has been stuck in a prolonged downtrend, investors often fall into despair. But when a strong reversal pattern like the inverse head and shoulders forms, that despair shifts to hope and excitement, which accelerates upward price movement. Especially after the neckline breaks, even short-term investors jump into the rally, further boosting volume. And a rally supported by volume is generally known to be more sustainable. This shows that the power of the formation lies not only in its technical structure, but also in its ability to influence investor psychology. The movements of the price during the formation of the final shoulder often carry clues about the formation's future. If the price reacts upward without dropping to the lows seen during the head, this proves that sellers have lost control. This gives investors additional confidence. As a result, the price usually rises towards the neckline, and from there, a strong breakout is expected. Once the breakout occurs, the standard method in technical analysis is to project the target upward by the depth of the head. The fact that this measurement points to an extraordinary 1,450% increase actually reveals that there is very strong bullish potential in the market. Of course, such a large target will not be reached in just a few days. It will play out in waves. However, from a long-term perspective, such large targets provide investors with great hope and motivation. This is because the role of formations in market psychology is not only about prices reaching technical levels, but also about boosting investor confidence, which helps accelerate the move. For long-term investors, the development of such a formation is almost like a test of patience. The process of building the right shoulder often takes time and causes the price to move in a choppy manner. However, patient investors are the ones who get the chance to benefit from the big rally that follows. After the neckline breaks, the road toward the target will not be a straight line. Corrections, consolidations, and intermediate resistances are to be expected. What matters most is that the overall direction has turned upward. During this process, it is critical for investors to manage their emotions and keep sight of the bigger picture without being swayed by short-term volatility. In conclusion, the fact that the price is currently forming the final shoulder is a very strong signal that we are at the beginning of a rally. The target measured by the depth of the head, pointing to a massive 1,450% increase, suggests that the market may be heading towards a very large upward move in the coming period. These formations stand out as structures that inspire investor optimism, raise expectations in the market, and rest on strong technical foundations. Once the neckline breaks and the breakout is confirmed, the validity of the formation will be established, and the probability of progressing toward the target will increase significantly. Thus, after a long downtrend, it is now possible to say that a strong reversal is finally on the horizon.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.